A stop loss is a common tool investors use to manage risk. Let us walk through how it works and why it matters. At its core, a stop loss is an automated instruction to sell a security if it hits a specific price point. It removes the emotional burden of choosing when to exit a trade, executing automatically once your preset price is reached. You decide your maximum tolerance for a price drop, and the broker handles the sale if the stock hits that number. While a standard market order executes at the current price, a stop loss stays inactive until the price hits your specific threshold. If a stock falls to $90, your stop loss triggers a sell, helping you avoid the further drop to $75. Remember that during fast market moves, the price you get might be lower than your stop price due to rapid price changes. Stop loss orders are just one way to manage your portfolio. Thanks for watching and subscribe for more basics.